Hi everyone, a quick video for the end of the year for tax planning tips, whether you guys are individuals or businesses or companies. Let's quickly run through this so that we don't waste much more time. If you are a business owner, the first thing you need to do before you do any sort of tax planning is to check whether you're profitable. And if you do have a profit in excess of about $100,000, then you need to possibly take certain steps. The first thing you can do in order to reduce that profit is to pay the employee super early. Our team will be sending out a link or an email that will ask if you want to process your super early. We need to get it in before, say, the 12th or 15th of June, so that the amount gets put into your employees' super before 30th of June. That is crucial. And if we don't do that, then we miss out on the deduction. You will also save 0.5%, as you know, because our super rates are going up from 1st of July 2025. So paying it early means that you are saving 0.5% of super on every employee that you're paying. The next step you can do is to defer your income. If you're on cash basis, this is the only way it'll work. You basically try and push all the income that is supposed to be landing into your account before 30th of June, after 30th of June. So that's the second thing you can do. The third one is to pay all your bonuses or commissions to your employees and staff before 30th of June. The important thing to remember is the date of payment needs to be 30 June or before. And this is a good way of bringing down any sort of excess profits. And it's a timing issue. If you are going to pay them commissions or bonuses anyway, then might as well bring it forward a little bit. The fourth thing you can do is you can look at buying your assets early. We still have a write-off limit of under $20,000. The keyword being under 20,000, so it has to be 19,999 or under. And this is an ex-GST amount, which means if your asset is 22,000 or just under $22,000, that would work because we need the ex-GST amount to be 19,999. We do get a lot of questions being asked about secondhand cars being bought under that value. And yes, the answer is you can deduct it if it is used 100% for work. So that's that. And the last thing is you can look at paying off your rent 6 months in advance, maybe some insurance as well, and council rates and so on, especially if you know that they're coming up for due for payment in July, August, or September. As a small business owner, you do have the exemption of being able to claim any payments that you make 12 months in advance. So you cannot pay 3 years of rent or 2 years of rent and claim it all. You can only claim up to 12 months in advance. So that is the key thing to remember. Now, that was the general business rules. Now, if you are a trust, obviously you have to first check whether your trust is in profit. And if it is, after adjustments that is, then you need to distribute that profit. And that is where you need to work out who your beneficiaries are going to be. Beneficiaries can be, obviously, if you're part of a family group, then your spouse, children, and parents are part of that family group. Work out if they have got any sort of tax-free threshold remaining. Be very careful to see if mom and dad's healthcare card or pensions are going to be affected by this. But if not, then you can choose to distribute some of that money to them. So that is the next step, working out who you're going to distribute to. And making them aware is a good part of tax planning. That you basically say that your tax return will include some distributions from the trust. So please do not complete your tax return online so that we don't have some administrative issues later on. The other thing you should look at as a trust owner is to work out if you've got capital losses. or some non-performing assets. And this is especially good if you've got a capital gain in this financial year. So this is the 25 financial year. You can only offset losses, capital losses against capital gains. So yeah, make sure that you are getting rid of any non-performing assets so that your capital gains don't look massive. And if there are still leftover capital gains, remember to ensure if the 50% CGD discount would apply for any assets which have been held for 1 year or more. Then the last thing you need to do is you need to fill out and sign a distribution minute as a trustee. Our team does have like a template of minutes that we normally send around at this point in time. If you do get that email and you do have a trust which has a profit, then do remember to sign and send that statement back to us so that we can keep it on our files. If you need to speak to us about any distributions, do either make an appointment or just email me or message me. Right. The next thing we want to go into are companies. First step, always check your profitability. After adjustments, things like Division 7A interest and so on will affect it. So once you've worked out what your profit's going to be, we can look at working out whether any shareholders can be given dividends, so that the tax which has been paid by the company can come into good use. Once you've worked that out, you need to either sign a dividend minute or let the shareholder know that there's some money coming over to them, and then they need to declare that in their own tax returns. Generally speaking, dividends are declared in a tax return when paid. So the good policy here is to make sure that whatever cash needs to be paid out as a dividend is done so before the 30th of June. Now, the other big part about companies is your Division 7A loans. So generally speaking, when a director or an associate of a director chooses to draw down money from the company and then live on it, that is basically borrowing money from a company and is termed as a Division 7A loan. The terms of this loan is that it has to be repaid within 7 years, and the interest rate is set by the government each year. So there is a minimum amount of repayment that needs to go back into the company every year. And in the absence of such repayments, we normally end up declaring a dividend to you guys. So if your income is pretty high, then the prudent thing is to pay the dividend back in, to pay the minimum repayment back into the company, which will negate any Division 7A dividends that we need to declare. The way to reduce the repayment is by paying off any of the company's debts. For instance, the ATO income tax debt from the previous year. You can choose to pay that yourself, and that counts as a repayment. Also, things like ASIC fees and so on are counted as repayments. So speak to us if this is unclear, but Division 7A, it needs to be managed, and there is paperwork that goes along with it. So please get in touch with us to know more. Another thing that affects most of our clients who have a company or even a business is the car. So a lot of our clients run their cars through their companies, and we need to work out whether any FPT applies. And the ATO now basically are pretty strict on working out whether a company is paying car fringe benefits tax. The way we normally avoid car fringe benefits tax is we show something called an employee contribution. An employee contribution is nothing but the director paying back the personal use of the car to the company. It is normally calculated at 20% of the value of the company, inclusive of GST when it was bought. So for instance, if you bought an $80,000 car, including GST, you're paying back 20% each year to the company in order to avoid fringe benefits tax. Now, the way to minimize this amount is by keeping a car logbook. And the second way to work around this is to get the company to pay the fringe benefits tax. Thereby, the company bears the burden of your car being utilized by the director or a shareholder or an associate personally. Okay, so that's one more thing to keep in mind. And the last one we've seen is making sure that ASIC is paid. Now, a lot of our clients forget that ASIC is a separate thing to the tax office, and you need to pay whatever the fees are per year. It's, I think, a $321 fee. And you also have to sign a solvency minute to keep your company compliant and active so that it doesn't die off, right? Look out, if you haven't paid that figure, you would get a penalty notice in the mail. And if you need us to manage your ASIC, you can always write to us, and we've got a software here that sends out emails and SMSs reminding you to pay that figure. Of course, it's a fee that we charge, but that's because we are buying the software for it. So that's companies. Now, just quickly moving on to our individuals who are employed. And generally speaking, we do not have too many avenues of reducing tax. Obviously, the biggest ones are negative gearing, and the other one is to top up your super. So let's start with that. Topping up super basically is nothing but putting extra money into your own super on top of employer contributions. Every year we can do up to $30,000 per person in super contributions. So if you are on a $100,000 job, technically your employer would be paying about 11% into your super, and you should have at least another 19,000 that you can top up. The other good thing is you can bring forward the unused caps from the last 5 years and choose to use that in order to top up your super. So you can potentially put in almost like 50 to 100 grand depending on what your caps are. Now, if you choose to do that, then remember you need to contact your super fund and let them know that you want to claim a deduction. It is called notice of intent to deduct. And then before we file your tax return, we have to have an acknowledgement from your super fund that says that they agree to your deduction. They will also be reporting that to the tax office. So we do get a pre-filled report which has that figure of deduction already pre-filled. So you don't have to worry too much if that is the case. Income protection. Now, lots of you may have your own income protection through super. You need to check whether you can bring it out of super and pay it personally so that you can get a personal tax deduction for it. What we normally advise our clients to do is to work out the difference in premium between the super fund paying it and you paying it, because super funds get a bulk sort of buying discount, so the premiums might be lower. But if they are not, then our advice is to try and bring out the income protection component into your own personal name so that we can claim it in your own tax return. Going into working from home, you have to, most of our clients, I would probably say 80 to 90% would have this deduction in their tax returns. Remember, we need to have a diary of sorts, putting together how many hours you've done from home. Do keep in mind people take annual leave, and then there are public holidays to account for. So if you're telling us you work from home the entire year, we do need to work in how many annual leave days you would have gotten. And that forms part of our calculations here, so it's just better if you know that and you keep a diary. Donations, especially to churches and so on, the thing to remember is not all charities are deductible gift recipients, which means the GoFundMes are a great example. They are not endorsed charities, so we generally can't use them as a deduction. And we now check against an open register of deductible gift recipients that your donations are deductible. But now is the time to give the money, to donate, and to get a receipt for that. and you keep it in a folder on your phone, or you take a photograph of it and you save it in a separate folder called tax. That is what we're trying to get our clients to do, so that it becomes easier at tax time to show us your receipts or to send it to us. Now, for all our clients who are utilizing your car for traveling to and from secondary places of work, or to and from clients, or even carrying goods, please make sure you keep a log of or a diary of how many trips you're doing and the distance traveled. In a classic example, one of my clients who works in the fashion industry forgot that he used to carry boxes of samples in his car to and from work every once in a while. And, he just thought that's part of the job. But because the boxes of samples were bigger than 20 kilos, I basically said to him that we can use the car as a tax deduction. If this is something that you guys resonate with, remember, every secondary place of work that you go to, including training days, including visiting clients every rarely so often, things like that, or maybe even traveling to the airport to catch a flight. Every little bit helps, so make sure you keep that at the back of your tax minds. Financial planning fees. So if you do pay a financial planner in order to help you with your investments, we might be able to utilize a certain percentage of their fees. And we should be able to get the financial planner to give us the breakup of how much of their fees were in relation to investments and how much was in relation to advice. There is a very good article on the ATO on this very topic about how much you can claim in financial advice fees. For other things like clothing, uniform, laundry, all that sort of stuff, protective shoes, they're a big thing. It can sometimes cost $250 and above. Those kind of things you need receipts for. And also for items that you use at work, like laptops, headphones, and stuff like that. So guys, these are a few tips. I hope it helps you to increase or maximize your tax positions. Remember, if you have any questions, feel free to contact us. But get in touch and stay safe, and Happy New Year if we don't speak before then.